There's a lot of fear in the marketplace right now. We're seeing things that many of us have never seen before in our lifetimes. If inflation, interest rates, and other things haven't already scared the crap out of you, don't worry. After this video, we're going to settle your nerves and discuss exactly what you can do to protect your money, but also what's currently going on in this unstable financial environment to take advantage of to make some significant profits. If you're new here, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race. I've put together a passive income guide that you can download with the link below this video. All right, so let's talk about some of the three main key data points that you should be paying attention to now. And those are the inverted yield curve. You're probably going, inverted yield curves, what is that? We're going to get over that. We're going to get into that in just a second. Some historically significant inflation rates and the state of interest rates and what all of this means for you as an investor. Now, the foundation of all the economic markets out there, it always starts with something that really most of us don't really know much about: bond markets, right? That is the foundation of all the economic markets. Why? So why does this matter? Well, check this out. The bond market actually has a market cap of over 119 trillion with the T, trillion dollars. Compare that to the stock market, 117 trillion. So actually, the bond market is actually larger than the stock market. Bonds are the most foundational investment vehicle of all the financial markets. And given their size and their risk profile, typically whenever they move, everything else starts to move. All right. So now that we know sort of the foundation, what about this yield curve that you were talking about? What is that? What does a yield curve inversion mean? Well, bond yields have an inverse relationship to bond prices. Okay, so the higher the price the investor is willing to pay for a bond, the lower the bond yield, just like cap rates. Okay, so bond yields, inverse relationship to the bond market. So the higher the price, the lower the yield, just like cap rate. So in cap rates in real estate, the higher the cap rate, let's say that's a self-storage facility, if it's trading or selling for a higher cap, typically the price is going to be lower. And then as that cap rate decreases, say if it goes from a 6 to a 5 to a 4, the price goes up. So same thing with bonds, inverse relationship. So when demand for long-term bonds increase very significantly, it actually reduces the yield of those bonds. Again, similar to cap rates. So let me show you on a diagram exactly what this looks like as far as the inverted yield curve right here. Now we see what our inverted yield curve looks like. Now, usually if somebody is willing to invest in a bond that's longer over time, they'll expect a higher yield. Okay, so if somebody loans money, which is exactly what a bond is, so it's a loan. So if somebody loans money for a longer period of time, say 10 years versus 3 years, then they'll typically want a higher interest rate. Okay, this is what takes place in normal economic time. So on the graph here, the x-axis is interest rate as it goes up, and the maturity of the time. So typically the longer that you hold it, typically in normal economic times, you'll expect a higher yield. Okay, so if this is a 2-year bond right here, and then 5, 10, so typically it starts to increase the longer that you hold it. Again, normal economic times. On the flip side, you can get higher yields in a shorter term. So you can get a higher yield in shorter term securities during periods with this inverted yield curve. So for example, like a 2-year bond would yield higher than a 10-year bond, which really doesn't make sense, right? When fear enters the marketplace, people rush to bonds because they see that as security and they rush to bonds. So if you have all these people in the marketplace wanting to buy bonds, what does that do? That increases the demand. Okay, so if you have an inverted yield curve, this is what the inverted yield curve looks like. So it's the opposite of normal economic time. So 1, 2, 3-year bond is actually a higher interest rate, and the longer that you hold it, the longer that rate it decreases. So what does all this mean? So a surge in demand for longer term bonds, it actually signifies that investors are worried about economic recession and they want to lock in these long-term US government bond yields, which again is considered the safest class. Now, check this out. Every recession in the last 40 years has been preceded by an inversion of the 10-year and the 2-year bond yield, meaning, again, the 10-year bonds are going to produce a lower return than the 2-year bonds. So the 2-year bonds are going to be giving you more yield than 10-year bonds. Every recession in the last 40 years has been preceded by this inversion. Okay? So now we know something for a fact that is a recession indicator. Okay, but Jeff, what does all this mean for real estate valuations? Well, does this mean if we invest in real estate, we're going to lose money? Typically, this is not the case. Even during recessions, it's typically rare to see 10, 20, 30% corrections in real estate markets. And because of this, real estate has only declined 8 out of the last 60 years, which guess what? Guess what those 8 years were in? Recessions. So it's only declined 8 in the last 60 years, recessions. Now, while recessions do not typically indicate significant changes in real estate prices, interest rates, on the other hand, can have a material impact on individual transaction volume and the cap rates. So the transaction volumes may actually fall off the maps and cap rates may expand, or there becomes too much of a delta between the buyers and the sellers. So guess what? If you have too much of a delta, deals can't get done, right? So why are interest rates rising to begin with? Well, remember all that money that was printed, like $1.3 trillion in 2008 for bailout money, and then there was like 5 or 6 trillion back in 2020. This actually brought the debt over $9 trillion. So this now seems to be the trend, because as soon as politicians see signs of recession, guess what? Excess money is printed and distributed. So interest rates are rising whenever you print money. So whenever money is printed, thus you cause inflation. Now, because this is happening, typically the Fed, they start to raise interest rates to cool off the economy, especially when the poor and the middle class start to get squeezed due to high prices. Food prices go up, gas prices go up, Fed comes in, they start to raise interest rates, economy starts to slow down, starts to cool, things start to balance up the other way. And then when it gets too skewed the other way, then the opposite thing happens. But here's the secret about rates that really nobody's talking about. And a lot of this information I've got from one of my mentors, Hunter Thompson. And he states, again, something that he told me recently was the secret about these rates that nobody's talking about is that interest rates are negative right now in real terms. So the 10-year bond, remember the 10-year bond yield is lower than inflation. The 10-year bond yield is lower than inflation. And interest rates are higher than what you can get out of investing your money in a 10-year bond. Isn't that incredible? So it's not just the bond that it affects, it's also happening with mortgage rates. So not only the interest rates are negative in real terms, the mortgage rates are as well. So inflation is higher than borrowing money to buy houses. Let me repeat that. Inflation right now is like 8 or 9%, and to buy a house is like 5.5%. Inflation is higher than it is to borrow money on your house. Let me show you this in a chart. All right, so let's look at this as a form of a visual, okay? So you have this line here represents inflation. This is 2019 through 2022 through current. And this line right here is kind of an ongoing rates of the mortgage rate. So right now, in mid to late 2022, 30-year mortgage, we're sitting at around 5.5%, roughly, depending on where you are in the country, 5.5%. But inflation, depending on who you talk to, could be 8, 9, 10%. So inflation is higher than mortgage rates. So mortgage rates are actually negative, okay, in real terms. So negative real rates, okay, so when you have this going on, negative real rates are highly bullish for stocks, real estate, and other equities, and they actually incentivize investors to basically quit being a spectator and get off the sidelines. So for instance, if you're a bond investor getting like a 3% return, but you realize that inflation's at 8 or 9%, what are you going to do? Well, if you're smart, you're going to move into something a little bit more risky, a riskier asset, or guess what? You're going to continue to lose your money due to inflation. So what does this mean to you as an investor? Well, the combination of inflation and these negative real rates, it actually provides investors with something that, again, my mentor talked about to me recently on a coaching call called the Investor Trifecta. All right, so let's talk a little bit about this investor trifecta. Three things that are happening that are all very bullish for investors, okay? So inflation and negative real rates, again, they come together and they provide you and me, the investor, with this investor trifecta, and that is this: the equity valuation inflation, the consumer price inflation, and the inflationary debt destruction. Okay. Almost everybody right now is talking about what? Number two, the price inflation. Gas prices are going through the roof. Energy prices, food prices. So turn on the news. Everybody's talking about the CPI, the Consumer Price Index, but inflation. But very, very few people are discussing, very, very few people even know about number three. So let's get into all three of them. All right. So the first part is this equity valuation inflation. And this is basically an increase in the multiple. So this is an increase in the multiple of income on which financial assets trade. All right. So when money is printed, the dry powder, the cash on hand, guess what? It increases, right? You print money, then you got more people, more institutions with money in their pocket. So all of this money, and we're talking about trillions and trillions of dollars. So all this money, it first works its way through the financial systems, then through consumer prices, okay? Meaning, if there's a massive demand for investments, people are going to be willing to pay more for the same stream of income, okay? So think about this. Gas prices are going up, but if you load people down with money and you got all these gas prices going up, you're seeing right now more and more people are going towards EVs, electric vehicles. Guess what? These EVs, their prices are going up because the prices of batteries are going up. But again, there's such a high demand that people are willing to pay more for that same EV, just like this. So if there's a massive demand for investments, people like real estate, people are willing to pay more for the same stream of income. Okay. This is the equity valuation inflation. Now in real estate, as more money was printed, people were willing to pay more for the same properties because there's more money supply and the same amount of goods. People pay more for these same goods. In real estate, people only care about one thing: the difference between the income and the expenses, what's left over. That's the NOI, that's the net operating income. So in real estate, the net operating income, how much money that property, that apartment, or that self-storage unit, or that mobile home park, or RV park, or whatever, how much money, after it's all said and done, is that asset producing every month, every year? That's how these things are valued. That's how these things are bought and sold, the net operating income. Now, let's talk a little bit about private equity. So right now, private equity dry powder, cash on hand, are at all-time highs, okay? All-time highs. Just to kind of give you an example, back in, let's say, 2023, the private equity had around $500 billion with a T, $500 billion in private equity money. Fast forward to today, it's about $3.5 to $4 trillion. Okay, so first, all of this printed money, it works its way through the Fed balance sheet, the Federal Reserve balance sheet. Then it works its way through the bond market, then it goes down to the private equity, etc. Meaning, all of this printed money, it has all these little legs on it, and it really right now it seems to just be getting started. Okay, That's the concept, what we just talked about. That's the concept of the equity valuation inflation. It's the direct correlation between the overall money supply, okay? The direct correlation between the overall money supply, the amount of money chasing investment opportunities, and the multiple income investors are willing to trade at, okay? That's the equity valuation inflation. That's the first, okay? That's the first of the three legs on our investor trifecta. Now, once all this money is printed, and then once all this money is given out and it starts to circulate, then that's when we see number two start to happen. That's what we're seeing now, okay? The consumer price inflation. Everything's going up. The cost of consumer goods are rising. Would you agree? I think so. Now, again, like I discussed earlier, many people make the mistake of thinking that real estate, and you've probably heard this before, real estate is a hedge against inflation. Real estate is a hedge against inflation. That's what everybody's touting. When the reality is that inflation is actually highly bullish for real estate owners. And here's why. It's because of, number two, the consumer price inflation. Let me explain. Now, assuming inflation impacts your top line, your income, remember, the income and the expenses. So if you have an apartment complex, you have your income, your gross income coming in, people paying rent, people paying for a place to store their car, people paying for a washer, dryer, whatever, all the income coming in the building, and then you got your expenses going out. So if you assume inflation impacts your top line and the expenses equally, the fact that you're compounding the gross income, you're compounding it. Let's say it's 8%. So you're compounding the gross income and your expenses, and the gross income, which is usually much higher than the expenses. That means that the net is going to actually increase significantly. Okay. So if inflation impacts both your top line and your bottom line equally, then there's usually going to happen is there's going to be a lot more top line, which is a gross income, than there are expenses every single year, and it starts to compound. So you're the benefactor owning the real estate. So what does this look like? All right, so let's take a look at what 8% inflation does to real estate net operating income. All right, so up here, we're going to use a multifamily example, okay? So year 0, and we go through 5. Well, let's just stay up here for right now, okay? So whenever this apartment was purchased, okay, the gross income, this is year 0, the gross income was $1 million with expenses of $400,000. So $1 million minus $400,000 give you the net operating income, which in this case is $600,000, okay? Now, when you apply the 8% inflation rate to the gross and you apply it to the expenses equally, so in the first year, you have about an $80,000 gain in the gross income. And again, expenses are going to increase too, but they're only going to increase by $32,000. This went up 80 grand. This went up $32,000. But look what happens to the NOI. It actually increases by $48,000, and that's just year 1. Now, if this scenario were to happen year after year with this particular property, and you had started with a $600,000 NOI when you bought it, well, now if you fast forward to year 5, guess what happens? It goes up to $880,000 from $600,000, okay, in year 5. So remember, all of this is compounding with what's going on with the equity valuation inflation. The inflation on the prices, again, at what investors are willing to trade the NOI, what they're willing to purchase it for. All right, so what does this 8% inflation do to the valuation? Okay, so we're going to talk about the cap rates now. Remember, the cap rates are a lot of times what people look at. It's like if you were to buy a building for all cash, what is that building or is that property going to net me over time? So if it's trading at a 5% cap, well, if you buy that apartment building for all cash, then you can expect to get roughly a 5% yield. That's what the cap rate is. Okay, it's a net operating income. It's the NOI divided by the purchase price. So if the NOI, just for easy numbers, if the NOI is $100,000 a year and the purchase price is $1 million, $100,000 divided by $1 million, that's 10% cap rate. Okay, so let's talk about what 8% inflation is going to do to real estate valuation. So if in this instance, if you had a value of the same property, okay, if you applied a 5% cap rate to it, and if you apply the 5% cap rate to it, to that NOI figure, the property that basically you purchased for $12 million initially, fast forward to year 5, is now worth over $17 million. Okay, that's if the cap rate, this 5% cap rate, it stays the same. Okay, that's what the 8% inflation does in this scenario with a 5% cap rate. All right, look what it does to 4% cap rate. 4% cap rate, remember over here, the lower the cap rate, the higher the price, okay? So the cap rate went from 5% and went from 5 to 4%. So the lower the cap rate, the higher the price. So now it went from the purchase price from $12 million to $15 million. 8% inflation applied every year. Fast forward, so instead of it being worth $15 million bucks, now $22 million, okay? Then we're going to look at a little bit lower, so only going down a half a percentage point. Look at the difference. Increases by $2.1 million. Fast forward to 5 years. Now, that same $12 million building that you purchased for a 5 cap, selling now at 3.5 cap, started at 17 million, it's worth 25 million. Okay? Incredible. All right. So this shows that inflation, I mean, this whole process that we're talking about, this shows that inflation is highly bullish for real estate investors. Okay? Highly bullish for real estate investors. Very few people talk about the third leg in the stool in the old investor trifecta, and that is the inflationary debt destruction. Not only does inflation destroy the value of the dollars that you have, but it also destroys the value of any dollars that you borrow, which, guess what? This is a massive benefit to you, the borrower. Okay, so when you borrow money and you pay somebody back later down the road, because of inflation, you're going to pay them less in real inflation adjusted terms, especially if we're in the environment that we're in now, if rates are negative in real terms. Let me repeat that because it's very important. When you borrow money, I'm not talking about on a credit card and going out and buying crap. I'm talking about when you borrow money and you're going to borrow it to get a cash flowing asset. When you borrow money and you pay back the bank, you pay back the lender later on down the road, because of inflation, you're going to pay that company, that person, that whatever, less in real inflation adjusted terms. Again, especially if rates are negative. Think of it this way. If I were to borrow 10 million bucks and said I would pay you back over 100 years, okay? If I borrowed 10 million bucks and I said I would pay you back over 100 years, think about the value of that 10 million bucks. What would that value be in 100 years? More or less? It's going to be less, right? Okay. But guess what? The bank, whenever you borrow that, the bank is the one that's doing the lending. Okay. So the value of what this is going to be worth, it depends on the inflation rate. But remember, again, the bank is the one doing the lending. So you can be the borrower. You can be the one borrowing in this situation, paying back, letting the inflationary debt destruction do its thing. All right. So in fact, at 8% inflation, which is pretty close to what we're at now, maybe higher, the value of $10 million in only 5 years, it almost cut in half. 6.6 million. Check out this visual here. So you have year 0 to year 5. You're going to borrow 10 million bucks. And again, at 8% inflation, the value of $10 million in today's dollars becomes about 6.6 million in just 5 years. Incredible. Wouldn't you agree? Now, the government, they understand this. They understand debt destruction with inflation. Okay? Now, Do you remember the massive multi-trillion with the T, the multi-trillion dollar money printing spree that the government went on back in 2008, which we said was about 1.5 trillion, and then 2020, which was about 5 trillion? Okay. So the government, they've realized this. They've realized that the only way out of the debt that they've created is to what? Inflate it away. The only way out of the debt that they've created is to inflate it away. Now, playing this game is their new way out of it. And by knowing this, we can use this information to prepare for it, in my opinion, as an investor. So think about, why would politicians ever accept a recession again? It really seems clear to me that anytime there's like an inkling or a hint of recession, guess what? The Fed's just going to print more money. They're going to print trillions of dollars. This will continue to inflate asset values. It's going to continue to make prices go up. Thus, it's going to destroy the debt. Does that make sense? So what does this trifecta mean for you? So what this means for you is this. Banks will let you borrow money to buy assets that will experience equity price inflation, net operating income growth, and best of all, they'll pay you to do it. Banks will pay you basically to borrow money in the situations that we are right now. Are you going to hear that on the news? I don't think so. All right, so we have all this, we've talked about all this for the last 25, 30 minutes, okay? What can you do now? How can we take this information? What can we do now moving forward? All right, so institutions like pension funds, endowments, foundations, individual investors like you and me, we're all able to see the same information that we just discussed, okay? Given that bonds are producing negative real returns, remember, bonds are negative rates. Investors out there, they have had all this money printed, bonds are negative. Investors are now going on a multi-trillion dollar search for yield. They need yield. Their bonds paying 2-3%, inflation's 8%. They can't continue to sit on the sidelines and have that just erode their investment. So where's that going to lead them? So it's going to lead them back into the bond market, some into the stock market, but many, many others are going into looking for areas for cash flowing assets, which leads us to this. The top three, in my opinion, inflation resistant cash flowing assets. We've talked about this before, but let me give them to you again, and let me give them to you why I think this. The first one is self-storage. So why self-storage in times like this? Well, think about this. They have very, very short interval of leases, and so they're very hyper recession resistant. They have these monthly leases. So people right now, prices going up, rents going up, a lot of people are downsizing. Okay, when you downsize, guess what? You need a place to put your crap, self-storage. When your kids go to college, a lot of times they'll move into an apartment, or they'll need some extra space. They're going to rent them. Okay, when people change jobs, when they move, if they're building a house or if they're just moving in general, they're going to rent them as well. Lots of movement going on. But check this out. If you own a self-storage facility, or you're an investor like me that's in these self-storage syndications, and the operators, the general partners, they actually raise the rents just by 5, 6, 7%. We're not talking about a ton of money, just bumping them up a little bit, again, to keep up with inflation. But it's really not going to affect the people that are renting them that much. Because think about it. If this person is renting something that's like 50, 60 bucks a month, and they bump the rent by 6, 7, 8%, that's not a whole lot of money. They're not going to sit there and go, okay, well, wait, that extra $7, $8 a month, I'm gonna take off work. I'm going to hire some movers. I'm going to load up all my stuff. I'm going to get a trailer. I'm going to load up all my stuff, and I'm going to move all the way across town just to save $10 a month on rent. Not going to happen. Not going to do it. This is why I think in times like this, hyper recession resistant asset is the self-storage asset, hands down. All right, my second one is this. The worse the economy gets, the higher the prices get, the higher the inflation gets, this number two, they do better. And that is this. You've probably guessed it. Mobile home parks. So the worse the economy does, the better these do. Guess who else knows this? Big people like Warren Buffett, billionaires like Warren Buffett. He's heavily invested in the mobile home park. He's bought Clayton Homes. He's bought the companies that actually finance the homes. He's bought the companies that actually insure these as well. So he's all in. He knows, if the smartest investor of all time knows, well, we can probably take a lesson or two from him. So with these mobile home parks, again, whether you own them outright or whether you're in a syndication and you're investing in maybe a mobile home park fund, something like that, you're a passive investor. Most of these parks, they have tenants that they're the ones that own their own mobile homes. And the only thing that they have to do is they pay the owner lot rents. They bring their trailer in and they pay $200-300 a month to rent the lot there. Okay? Because during times like this, there's always going to be a demand for affordable housing. Okay? Always. Which leads us to number 3. And that is one of my favorite, and I'm probably most heavily invested in this. These are going to be the multifamily assets, the apartment complexes. So not only are these recession resistant for many of the things that we discussed today, but the U.S. supply and demand at this time is really unbelievable. New developments of single-family homes have not yet recovered from the challenges of 2008. So we're actually short in the U.S. somewhere between 3 to 5 million units of housing. And guess what? It's only getting worse. Now, again, don't forget about the trillions of dollars that we discussed earlier that's about to come crashing. It's still working its way through these markets. And this is going to give us, even for real estate investors, going to give us better opportunities because all this money is crashing into the markets. It's actually looking for better yields. Okay. So again, inflation-resistant cash-flowing assets, self-storage, mobile home parks, multifamily assets. Now, if this is some of this information and some of these investments, if this is something that interests you and you're an accredited investor, if you're not sure what an accredited investor is, the IRS states it's either based on your income, you make $200,000 a year single, or you make $300,000 a year or more married, filing jointly, or your net worth. So that's your income, $200,000 a year single, $300,000 a year married, or your net worth is $1 million a year, not including your house. You're considered an accredited investor. So if you're an accredited investor and you're interested in access to some of these investments that I personally invest in, I'm going out, I'm meeting with these people that are finding these deals. I'm meeting with these people that are managing these deals, that are paying cash flow every month, every quarter. Click the link below and join the Passive Investor Circle. It's free, okay? Again, these are the investments that I'm personally investing in, that I'm vetting these groups to provide these types of investments and more. Links below, Passive Investors Circle, also the Passive Investors Guide, links below. Thanks for watching.